So before we talk about short-term volatility of the exchange rate, we have to be able to identify long-term changes which describe the general direction that the exchange rate is taking over time. So if, for example, we go to slide 5, we will see that the price of a Canadian dollar in terms of US dollars, so the exchange rate between US dollars and Canadian dollars, has had a downward trend from the 70s, so from after Bretton Woods ended, to the early 2000s. That is identified by the red arrow in our plot, and then since then it seems to have picked up an increasing trend that has brought up the level of the exchange rate to the original level in 1974. So sometimes economists identify these long-term changes in economic variables, for example the exchange rate, by fitting a straight line to the time series of the economic variable over time. Sometimes trends are not just linear, which would be corresponding to the straight line, but sometimes this term can exhibit non-linear patterns. An example of this we're going to see in slide 7, in which we see that in which we represent the exchange rate between US dollar and the Japanese currency, the yen. We see that we can represent the growth of the yen over time by a line that seems to have kind of an exponential growth. Okay, so the choice of a trend is subjective. There's not an exact way of representing a long-term trend, but qualitatively we can see if a time series is exhibiting an upward trend in the long run or a downward trend in the long run. And probably when we think about short run and long run, for long run in this situation we should think about a time horizon that is longer than 5 years. For short run we should be thinking about a quarter or a year or 2 years. So a time horizon that is considerably shorter than the long run.